17%. In a single session, silver clawed back from the abyss at $71, surging to $83. Gold recovered $250 from a $450 collapse. Bitcoin, the early warning system, had already spoken at 74,500. But here's what the institutions are not telling retail investors. Violent bounces in bear markets have a name. They call them bull traps. And right now, as New York prepares to open, one critical question separates the prepared from the exposed. Is this capitulation or the setup for the next leg down? The next 7 minutes will determine how you answer that question. Welcome to Silver Radar. If you've been navigating these markets for a few decades now, you know that experience teaches what theory cannot. You understand that volatility like this doesn't just happen. It's engineered. And those who see it coming position themselves accordingly. Now, if you value this kind of strategic analysis, the kind that cuts through the noise and gives you the framework serious capital allocators actually use, do me a favor, hit that subscribe button, not for algorithms, but because knowledge like this belongs in the hands of those who will actually use it. And before we dive into the structure of what just happened, drop a comment below. Tell me where you're watching from. Are you in North America, Europe, Asia, somewhere else entirely? I want to know, because this market moves globally, and so does this community. Now, let's get into what really happened overnight. At approximately 2:30 a.m. Eastern Standard Time, silver hit $71 per ounce, a price level that just hours earlier would have seemed impossible to most market participants. But in the span of a single overnight session, the impossible became reality. And then, something even more remarkable occurred. Within 12 hours, silver had surged 17%, climbing back to $83. This was not ordinary price discovery. This was forced liquidation, followed by panic repositioning, the kind of movement that separates institutional capital flows from retail sentiment. Gold, silver's larger and more liquid counterpart, told a similar story. It collapsed to $43.99, a psychologically significant level, just 1 penny away from breaking the $43 threshold. From its intraday high, gold had shed $450, a decline that triggered cascading margin calls across futures markets, options chains, and leveraged ETF structures. But gold, being the more stable of the two precious metals, recovered only 250 of those 450 lost dollars, a 55% retracement. Silver, by contrast, retraced nearly 70% of its collapse. From the intraday low, gold posted a 7% gain. Silver, 15%. Why does this matter? Because percentage gains in isolation tell you nothing. What matters is the structure beneath the movement, the volume behind the recovery, and the participants driving the flow. When silver moves twice as violently as gold in both directions, it signals one thing: leverage, excessive leverage, being unwound, and then rebuilt in compressed timeframes. This is not investor behavior. This is trader behavior. Specifically, the behavior of large-scale institutional traders, hedge funds, and commodity trading advisors who operate with position sizes that dwarf retail participation. Consider the mechanics of what occurred. When silver dropped to $71, thousands of long positions were forcibly liquidated. Margin calls do not wait for market hours. They execute automatically, selling positions at market prices, regardless of depth or liquidity. This creates a feedback loop. Selling triggers more margin calls, which trigger more selling, which creates a price vacuum. And in that vacuum, the most aggressive participants, the ones with capital reserves and risk appetite, step in, not because they believe silver has bottomed, but because mathematical probability favors mean reversion in oversold conditions. The 17% bounce was not optimism. It was statistical arbitrage. Professional traders know that when an asset falls 10, 15, 20% in hours, a reflexive bounce is almost certain, not because fundamentals improved, but because short-term positioning became unsustainably one-sided. Now, here is where the analysis becomes critical. The New York session had not yet opened when this recovery occurred. Asian and European markets drove the initial bounce. But New York, where the largest commodity futures market operates, where the deepest liquidity pools exist, had yet to render its verdict. Would American institutional capital validate this recovery? Or would it fade the bounce, selling into strength, and resuming the broader downtrend? This question was not academic. It represented the difference between a tradable bottom and a bull trap. History provides context. In March 2020, when COVID lockdowns triggered the first wave of global panic, silver collapsed from $18 to $12 in 72 hours. It then bounced 30% in the following week. Retail investors, seeing the bounce, concluded the bottom was in, they bought aggressively. Within 2 weeks, silver had retested the lows, trapping those buyers at elevated prices. In September 2022, when the Federal Reserve signaled aggressive rate hikes, silver fell from $26 to $17. It bounced 12% over 3 days. Again, retail capital flooded in. Again, the rally failed, and prices declined another 15% over the following month. The pattern is consistent. Violent declines produce violent bounces, but bounces without structural support are traps. So as silver sat at $83 with New York minutes from opening, the critical question was not whether the bounce was impressive, it was whether the bounce was legitimate. And to answer that question, one had to look beyond silver itself. One had to examine the broader risk architecture, the cross-asset signals, the leading indicators that move before precious metals. One had to look at Bitcoin. The markets do not move in isolation. They move in sequence. And those who understand this sequence trade with an advantage that most will never possess. Bitcoin closed the weekend at $76,000, a number that should have sent shockwaves through every commodity trading desk on the planet. Because just days earlier, a critical threshold had been identified, $82,000, the line between controlled decline and cascading failure. Bitcoin did not just fall below this level, it collapsed through it, crashing to 74,500 overnight. And in that collapse, it spoke a language that precious metals traders ignore at their own peril. Because here is what the textbooks will not teach you, what the financial media refuses to acknowledge, and what separates institutional capital from retail hope. Cryptocurrency, specifically Bitcoin, functions as the early warning system for risk asset behavior, not because of fundamentals, not because of correlation coefficients that academics debate, but because of participant overlap, the same hedge funds, the same macro traders, the same algorithmic systems that move billions through crypto markets, also control massive positions in commodities, equities, and derivatives, and when they de-risk in one market, the contagion spreads like wildfire through their entire portfolio. The prediction was explicit. If Bitcoin closed below the 80 to 82,000 range, expect selling pressure to spread across risk assets. It closed at 76,000 24 hours later. Silver hit $71. This was not coincidence. This was mechanical transmission of risk sentiment across interconnected markets. The crypto sell-off preceded the precious metals collapse by 12 to 24 hours, giving those who monitored cross-asset signals a brief but actionable window to adjust positioning before the storm arrived. Professional trading desks maintain dedicated personnel who do nothing but monitor these leading relationships. They watch Bitcoin futures, tick by tick. They track Ethereum's behavior against risk parity funds. They measure the delta between crypto volatility and VIX spikes. Because in modern markets, where algorithmic trading dominates flow, where risk gets recycled through complex derivative structures, the old barriers between asset classes have dissolved. What happens in crypto at 2 a.m. does not stay in crypto. It migrates to gold by 4 a.m., to silver by 6 a.m., to equity index futures by the opening bell. The 82,000 level was not arbitrary. It represented a confluence of technical support, institutional cost basis, and psychological anchoring. Below this level, stop losses triggered across multiple timeframes. Below this level, momentum algorithms flipped from buy to sell. Below this level, the narrative shifted from correction to breakdown. And when Bitcoin tested 74,000, when it breached that next layer of support, it confirmed what the framework had predicted. Significant weakness was spreading, and commodities would be next in line. Now here is where it gets critical. Bitcoin has bounced from its lows, climbing back above 77,000 as of this recording. But the question is not whether it bounced. The question is whether this bounce holds through New York trading, whether institutional capital in the United States validates what Asian and European markets started. Because if Bitcoin fails here, if it rolls over and retests 74,000 or breaks lower, silver's 17% recovery becomes nothing more than a reflex, a dead cat bounce in a market that has not finished falling. But if Bitcoin reclaims 80,000, if it shows sustained buying above that level with volume confirmation, then and only then does silver's bounce gain credibility. This is not theory. This is operational reality in 2026 markets. Ignore Bitcoin and you are trading commodities blind. Monitor Bitcoin and you gain 12 to 24 hours of advance warning. That edge, in volatile markets, is the difference between preservation and devastation, between strategic positioning and panic reaction. The leading indicator has spoken. The question now is whether anyone is listening. 17% sounds impressive until you understand what it actually represents. In bear markets, violence works in both directions. And the most dangerous rallies are not the ones that fail immediately, but the ones that look legitimate just long enough to pull capital off the sidelines. just long enough to convince traders that the worst is over, just long enough to trap them at prices that will look foolish 2 weeks later. This is not cynicism. This is market structure. And right now, as silver sits at $83 after clawing back from 71, every technical indicator that matters is flashing the same warning. Relief rally in progress, not trend reversal. The difference between these two is not semantic. It is the difference between opportunity and catastrophe, between a tradable bounce and a wealth-destroying trap, and the evidence is mounting in ways that demand attention. Start with volume, because volume never lies. When genuine bottoms form, when smart money decides a market has reached capitulation, volume characteristics are unmistakable. You see sustained institutional accumulation. You see large block trades. You see dark pool activity that persists across multiple sessions. You see conviction. What we are seeing in silver right now is the opposite. Short covering, panic buying from those caught on the wrong side, algorithmic mean reversion programs, none of which indicate institutional belief that a bottom is in. This is mechanical buying, not strategic positioning, and mechanical buying exhausts itself quickly. Now look at the structure above current price, between $85 and $87. Silver has accumulated a massive supply zone. This is where buyers from the previous rally got trapped. This is where stop losses are clustered. This is where resistance is not just technical. It is psychological. It is emotional. It is financial. Because every trader who bought silver at $86 and watched it collapse to 71 is now praying for a chance to exit at break even. And markets have a cruel way of giving them exactly that chance before rolling over again. History is instructive here, painfully instructive. March 2020, silver collapsed from $18 to $12 in 72 hours during the initial COVID panic. It then bounced 30% over the next week. Retail investors saw the bounce, concluded the bottom was in, and bought aggressively. Within 2 weeks, silver had retested the lows, trapping those buyers underwater. September 2022, Federal Reserve signaled aggressive rate hikes. Silver fell from $26 to $17. It bounced 12% over 3 days. Again, retail capital flooded in. Again, the rally failed. Prices declined another 15% over the following month. May 2023, banking crisis fears triggered a silver spike to $28, followed by collapse to $22. The subsequent bounce captured 13%. Failed within a week. November 2024, election uncertainty drove silver to $32, crashed to $26, bounce of 11%, failure within days. The pattern is not random, it is systematic. Bear markets produce these counter-trend moves with mechanical regularity, and they serve a specific function in market ecology. They shake out weak shorts. They pull in optimistic longs. They reset sentiment just enough to enable the next leg down. Professional traders understand this. They do not fight these bounces. They fade them. They sell into strength. They use the relief rally as a gift, an opportunity to exit positions or establish shorts at better prices than the panic lows offered. And this brings us to the moment that matters most. The New York session open, because everything that happened overnight in Asian and European markets is prelude. The real verdict comes when American institutional capital enters the arena, when the largest commodity futures market on the planet renders its judgment, when the deepest pools of liquidity decide whether to validate or reject this recovery. The first 60 minutes of New York trading will tell the story. If silver holds 83 and pushes toward 85 with volume, the bounce gains credibility. If it stalls, if it struggles, if selling emerges into strength, then this 17% move becomes what market veterans know it likely is, a bull trap. Textbook in its execution, devastating in its consequences, and entirely predictable to those who read structure instead of hoping for miracles. The question is no longer what happened. The question is what happens next, and more importantly, what you do about it. Because in markets like these, where 17% moves occur overnight, where correlations break down and reassemble in hours, where leverage amplifies every decision into either fortune or ruin, having a framework is not optional. It is the only thing standing between strategic capital allocation and emotional destruction. And that framework begins not with prediction, but with probability. Assign the scenarios their weight. Bear case continuation. 50 to 60% probability. This is not pessimism. This is reading the macro backdrop without bias. Global central banks remain restrictive. The Federal Reserve has not pivoted. The European Central Bank maintains hawkish guidance. Real yields across developed markets stay elevated. The dollar, despite short-term weakness, holds structural support. And in this environment, commodities face persistent headwinds. The signs to watch are clear. If Bitcoin breaks $72,000, if silver fails to hold $80 on a daily closing basis, if gold retests $43,000, the bear case activates, and the next leg down will make this week's volatility look tame. Consolidation scenario, 25 to 30% probability. This is where silver enters a trading range. $80 is support, $88 is resistance. Choppy, grinding, frustrating for both bulls and bears. This scenario requires Bitcoin to stabilize between 75 and 82,000. It requires equity markets to find equilibrium. It requires no major macro shocks. And in this range-bound environment, the game becomes tactical, not strategic. Buying the lower bound, selling the upper bound, taking profits quickly, managing position size tightly, because ranges eventually break. And the direction of that break determines the next major trend. Bull reversal scenario, 15 to 20% probability. This is the outcome that requires everything to align simultaneously. Bitcoin must reclaim $82,000 with conviction. Not just touch it, but close above it on increasing volume for multiple sessions. Silver needs a daily close above $88 that holds. Gold must break above 46,000 and sustain. The dollar index must show sustained weakness below 103. And institutional volume must confirm that smart money is accumulating. Not just algorithms mean reverting. All of these conditions simultaneously, which is why this scenario carries the lowest probability. Hope is not a strategy, and waiting for perfect alignment while deployed with full capital is how accounts get destroyed. Here is what separates professional capital allocators from those who donate money to markets. Professionals scale their entries. They never commit everything at a single price. They understand that being early and being wrong look identical in the short term. So they build positions in tranches, risk 5% of intended allocation at $80, another 5% at 76 if it gets there, another 10% at 72 if the structure breaks that far, and they maintain dry powder, always. Because the best opportunities come when others are forced to liquidate, not when everyone is buying the bounce. Capital preservation outweighs catching bottoms. This is not a platitude. This is mathematics. If you lose 20% chasing a false bottom, you need a 25% gain just to break even. If you miss the first 10% of a real bottom, you still capture the majority of the move. The asymmetry is obvious. Patience costs opportunity, impatience costs capital, and capital once lost requires exponentially more risk to recover. Sophisticated participants understand this, which is why they focus on not losing rather than on winning big. The monitoring protocol is simple but non-negotiable. Watch Bitcoin daily closes relative to 82,000. Watch silver's behavior at the 85 to 87 resistance zone. Watch the dollar index for breaks below 103. Watch volume patterns for institutional fingerprints versus algorithmic noise. And most critically, watch your own emotions, because the greatest risk in volatile markets is not the market itself. It is the decision-making that panic and greed produce. Independent analysis beats social media narrative every single time. Structure trumps emotion, probabilities guide position sizing, and discipline, not prediction, determines who survives to trade another day. This is not entertainment. This is capital warfare, and those who treat it as such, who build frameworks instead of following feelings, who scale instead of swing, who preserve instead of predict. These are the participants who compound wealth across decades, while others blow up chasing 17% bounces that looked like bottoms until they were not.